Amy, I think you froze. There you go. No, that's okay. Yeah, no problem.
Before I come in, I try to invite people. I think at 10:35 we can start at 10:35, right?
Perfect.
Yeah, what are you going to talk today?
So there's yeah. So I just shared my screen. You know, with the new year, everybody starts at ground zero again, right? So you have to start with production. You got to start with you know, some sales ideas and maybe learn new ways to prospect. And so for us, Amy, what that means is reiterating some of the key reasons why individuals would want to work with Equitable Life. I'm going to go through some of the key spots that Equitable Life has been extremely competitive with. And at the end of the presentation, I'm also going to highlight a couple of the things that are going to be happening this year that I think are going to help you and your advisors to generate more business, because we are making some changes. And I think it's important for you to know, especially as the new year is starting off.
Yes, I think we can start now, right? And people will come in, more people will come in, but then I think we can start.
Okay, perfect. And so I want to thank you for taking the time to join us this morning. I don't know what it's been like for you at the start of the year, but I've been speaking to a couple of advisors who have told me that their January has been a bit more sluggish. Doesn't really start the way that they, you know, our current environment doesn't really help us very much. But the first thing I wanted to do is I wanted to take the time to thank you for the support that you gave Equitable Life last year. You know, as an organization, we've done extremely well with respect to sales. We surpassed our targets for the last year, and it's good to see, given the environment that we were in. You know, I think advisors like yourselves did a very good job at being able to pivot and find new ways to prospect and find new ways to increase sales. I also think insurance companies came to the forefront and really made some changes that allowed advisors to continue to push business forward. And as I said at the beginning, you know, one of the things that I wanted to do today is really just take the time. I don't know if we're going to use up the whole hour, but really just take the time to highlight some of the key reasons why advisors chose to work with Equitable Life last year. And for those of you that haven't worked with us before, then maybe give you a little bit of competitive insight as to why you may want to consider Equitable Life as a valuable partner in your practice. And so with that, the first thing I will highlight is our commitment to mutuality. You know, I've talked about this in the past. Over the last number of years, we continue to talk about the mutuality of the organization. And as you've heard me say before, you know, oftentimes I hear advisors tell their clients that should consider purchasing a Equitable Life policy, a participating policy specifically, because when you purchase a policy from a mutual organization, if the company were to ever demutualize in the future and become public, anybody that owns a participating whole from some type of share ownership, if you have been in the business long enough, for those of you that, you know, were around through the mutualization stages in the late 90s, when Sun Life, Canada Life, and Manulife demutualized, you know, some people benefited from share ownership. And interestingly enough, I know a couple of people today that, you know, had Sun Life policies when they demutualized. And what they have now is share ownership, an additional nest egg, if you will, that will allow them to comfortably retire because it's just growing without them having to do anything. Now, that's one of the advantages of being a mutual organization. For me, and the way that I promote it, being a mutual company means that we are a policyholder company. We're not a shareholder company. And what that means is that we are not driven by shareholder pressures to provide quarterly results to them. Instead, our mutual structure really allows us to manage our company with a focus on long term. For us to be able to provide a high level of service at all times to our policyholders, given that we are policyholder centric, to offer continuity, and we pride ourselves in being dedicated to meeting our commitments now and in the future when it comes to providing those policyholder dividends. In addition, I feel that our mutuals really have Equitable Life has been regarded as one of the strongest life insurance companies in Canada from a financial and stability perspective, providing insurance products to Canadians since 1920. And with our participating whole life insurance facility, we've been paying policyholder dividends every year since 1936. And so we have a very strong track record of financial strength in paying policyholder dividends. Over the last little while, we have been an industry leader with consistently high LICAT scores. For those of you that aren't familiar with LICAT scores, it's the life insurance capital adequacy tests. And that really measures the strength of the organization in their ability to meet their liabilities long term. Our most current LICAT score at the end of Q3 in 2021 was a score of 166%. Which is well above the target ratio that OSFI sets out for the insurance companies. Now, our strong LICAT score, I feel, should give all policyholders confidence and the peace of mind that we have the financial strength and stability to meet our financial obligations to provide the benefits promised to our participating whole life insurance policyholders. The question is, how do we compare to other companies in the insurance industry? And so here what you're looking at is a slide that shows you the LICAT ratios as of the end of Q3. Now, the ratios presented on the slide are for the operating companies. I know that Manulife and Sun Life also disclose quarterly ratios for their non-operating or holding companies. And again, those holding companies are subject to different OSFI regulations and minimum ratios than the operating companies. And so the comparison here is specifically for the operating companies. So not to say that the other companies aren't financially sound, but what I like about this slide is that it really shows the financial strength of Equitable Life. And as you've heard me say in the past, oftentimes people equate size with financial strength. And I've had, clients, advisors say to me, well, I don't really know much about Equitable Life. It seems like a much smaller company. I know about Manulife, I know about Sun Life, I know about Canada Life. And my comment to you as advisors and my comment to those clients is size isn't necessarily indicative of financial strength. And that can be shown here with this particular slide with our 166% LICAT score as of the end of Q3. We continue to have a very strong position in the industry. When advisors or clients ask who Equitable Life is, and I tell them the Equitable Life story, part of the reason that folks aren't familiar with Equitable Life is because being a mutual company means that we don't take the time to invest or to market to the end consumer. Our end consumer is the advisors, and we answer strictly to policyholders. So having splashy banners on the side of a hockey rink, that's not something that Equitable Life is going to do. But we have a very strong position in the industry. If you consider where Equitable Life was in 2011 and prior to 2011, Equitable Life ranked 10th in the insurance industry as one of the insurance providers across the country. Fast forward to the end of 2020, we were ranked one of the top 50 insurers in the industry today. Of course, we don't know where the 2021 numbers are going to land us, but we had a very strong 2021 with respect to sales. And so I hope that our position will remain in 5th place, and if not, inch to the 4th place category. But you can see that we continue to be one of the market leaders in the industry today. A more compelling story to share with you is the percentage change of individual life insurance sales in the industry. And you can see that over the last number of years, Equitable Life has either been on par with the industry or has significantly outpaced industry sales. And again, that is attributed to the competitive nature of the product offering. It's attributed to the size of the organization and really where the industry has taken us, because our spearhead product continues to be the participating whole life insurance solution. And as you've seen in the industry over the last number of years, participating whole life insurance tends to be the product that is primarily sold in the industry today. To continue briefly with the financial highlights, when you take a look at the amount of growth that we've had over the last number of years, the one key component that I like to highlight is the bottom right-hand quadrant, which says dividends to participating policyholders increased by 24% in 2020. Why is that important? Fully knowing that our participating whole life insurance is our spearhead product, and that's the majority of the sales in the industry today, there's always a question as to how the policyholder dividends have held up, given that we continue to experience downward pressure with respect to interest rates in the industry today. And what you would have seen is you would have seen dividend scales across the industry just decreasing over the last number of years. But surprisingly, the amount of policyholder dividends that we've paid have actually gone up every single year. I'll share a story with you on that momentarily, but I think that that's important to have as well. As I mentioned, we continue to be a leader in the participating whole life insurance market space. When you compare the Equitable Life growth in whole life insurance sales compared to the industry, you can see that we've had a significant percentage increase over that, over those number of years compared to the industry as a whole. Today, in the MGA marketplace, we are considered to be the number one seller.
Hello?
Sorry, Jamie, can I ask you to mute the line?
Oh, sorry about that.
No worries. Thank you, my friend. And so, as I was saying, our success in the MGA market space, we continue to be the number one seller of participating whole life insurance by policy count. And when you consider where we are ranked in terms of market share in the MGA channel specifically, we are ranking number one. So a very strong story to tell and a very strong reason to consider working with Equitable Life if you haven't looked at us for any of our product offering, quite frankly. With respect to our participating whole life insurance products, as many of you know, if you work with participating whole life insurance, we have two product offerings. So we have the Estate Builder, which is really designed to offer competitive long-term cash values. And we also have the Equimax Wealth Accumulator, which was repositioned about 1.5 years ago to target high net worth clients, giving those clients the ability to put in extra deposits. So we were able to bump up the accelerator deposit option within these contracts. We also added some additional flexibility like many of our peer companies have. And so in the past, if you had a client who opted to utilize the accelerator deposit option, if the client wanted to stop, they had the ability to start and stop for up to 24 months. And if you didn't start it after the 24th month period, you lost the ability to put in these extra funds once that 24-month period expired. And so what we did, we changed that to a 5-year. And now your clients have the ability to start and stop for up to 5 years. We made it even more competitive in that if you want to lock in the accelerator deposit option room today, you can apply for it fully knowing that the client is not going to put in this extra deposit in year one. And you can defer the accelerator deposit option payments and settle the policy using the basic premium only. And what that does from an underwriting perspective is that it locks in the ability for a client to use this extra deposit room over the next 5-year period. One of the other things that we did with our Equimax Wealth Accumulator is we changed our chargeback schedule. Now, I know that there's a couple of folks on the line that in the past had sold our wealth accumulator under the old product guidelines, and unfortunately, when a client cancels before the 5th year, there's a 100% chargeback period. That has changed. And now what we've done is we've implemented a 25-month chargeback, which really lines us up with what all of the other companies are doing today. Now, why did we make these changes? Well, traditionally, from what you have known about Equitable Life was known as a mid-market organization. And frankly, we continue to be known as a mid-market organization. And what that means is that our products are extremely competitive for the family market. When it comes to pricing, when it comes to product features and offerings, what you're going to find is that between the ages of 35 to about 50, we tend to have some of the most competitive premiums in the industry today. And our cash values are actually very competitive as well. Now, we were missing the mark with some of the high net worth clients and the older clientele. And the majority of that business had been going to Sun Life and Manulife. And so when we implemented these changes for the wealth version of the product, what that allowed us to do is it allowed us to expand our target market to the individuals between the ages of 50 up to and including age 65. And so what we've been able to do over the last year and a half is we've really been able to penetrate some of these corporate-owned life insurance sales, some sales in the high net worth market space where maybe we wouldn't have seen it before. We've done a lot more IFAs than we've done in the past. And of course, the partnership that we have with some of the lending providers out there has also increased as well. One of the other points to mention on this particular slide, you see there it says EDO is available on cases that are rated up to 300% or less. So in the past, if a client was rated 200% and they wanted to take advantage of the EDO, that client was not able to qualify for EDO. And so what we've done is we've been able to bump up that amount. So if a client is rated up to 300% or less, they can still contribute to the accelerator deposit option as a way to accumulate additional funds on a tax-deferred basis. One of the other changes that we made as well, and not many people are familiar with, is this built-in disability disbursement benefit. So for those of you that are familiar with working with Universal Life, you know that many universal life insurance contracts had this built-in disability disbursement benefit, which allowed a client to obtain the cash value accumulation in the contract on a tax-free basis if they became disabled or if they were unable to perform 2 of 6 activities of daily living. That was introduced into our contract last year, and the client has the ability to elect anywhere from 0 to 100% of the cash value to be paid out on a tax-free basis to help with any of the disabilities that they may have. With respect to the accelerator deposit option, one of the things I wanted to discuss is generally how the accelerator deposit option works. I've explained when you can contribute, I've explained the flexibility and the rating, but over the last week, I've had a couple of conversations with a few advisors and clients that have said to me, how does the accelerator deposit option work? Like, is that money being invested inside the participating account, hoping to earn interest? And I think that that's a misconception that is currently in the industry today. Unlike universal life, the excess money you're putting into the contract isn't being invested into the account to earn interest. What it's actually doing for your clients is that any EDO payment made is buying participating whole life insurance that is paid up on a monthly basis to maximize the growth. And so if you think about how a traditional policyholder dividend would be credited, if Rudy bought a policy today on January the 13th 2022, and I paid my annual premium of $5,000, let's say, my policyholder dividend at the next anniversary, which is January 13th of next year, is going to be based on my $5,000 contribution and whatever face amount that purchased. Let's say it was $250,000. And so my policyholder dividend is going to be based on $250,000 death benefit and a $5,000 deposit. If instead I contributed $5,000 of extra deposits on an annual basis, that additional $5,000 of extra deposit, that's actually buying paid up insurance on a monthly basis. And as you know, the paid up insurance has its own cash value associated with it. And so you're starting to see the growth in the policy as early as day one. Now, how does the return work for the client? Well, simply, at my policy anniversary of January 13th next year, my policyholder dividend is going to be calculated on my original $250,000 of insurance that I purchased, on any paid up additions that were purchased over the year, and it's going to take into consideration the fact that I was contributing $10,000, not $5,000 a year. This is how the EDO works. And I wanted to clarify that because the more and more I talk to advisors and clients, the more they think that this extra deposit is sitting in the account earning interest. Now, it might surprise you. I was having a conversation earlier this week with two clients who are actuaries working at a reinsurance company. And they were of the impression that this extra deposit was actually being invested in the fund. And so I wanted to clarify it because, one, I don't think a client will understand it. I don't think clients understand it, but some advisors don't understand it. So I hope that adds some clarity to what I wanted to explain. A little bit on dividend scale interest rate. So obviously with the start of a new year, what we are going to see is we're going to slowly see companies introducing the dividend scale interest rates for 2022 going into 2023. Where do we stand right now? So our dividend scale interest rate for 2020 into 2021, keeping in mind that our new dividend scale interest rate takes effect on July the 1st of 2022, it's at a 6.5%. Currently, it is one of the highest in the industry. And I've been asked over the last little while where I feel this dividend scale interest rate is going to go. Last year, I had a very good feeling that the dividend scale interest rate was going to decrease. This year, I'm not sure. We've had some very good success in the equity market space where we've seen rates of return coming back up. We've had some very good experience with mortality and expense management as part of the portfolio. And as you know, that adds profitability to the overall participating account. So I don't really know where we might go this year. We still continue to see downward pressure with interest rates, but when you have all these additional, industry markers that are kind of offsetting this downward pressure, I'm not really sure. I hope it stays the same, but I'm not the one running the numbers behind the scenes. And so we'll see what the first quarter brings with respect to returns, and I think that'll be a good indication of maybe where the dividend scale is going to go in the future. Now, for when you compare the standard deviation over the last 25 years, our standard deviation is somewhere at around a 1.5%, so very conservative. And our yield for 2020 was 5.1%, which includes policy loans, and it's net of fees. And I'll show you a slide on yields momentarily. One of the things that I think is important to talk about when it comes to dividend scale interest rates and yields is really how we manage the portfolio. So our team is what I consider to be more of an active style management. We have a top-down management approach with a bit more hands-on than some of the larger counterparts. And that's just, again, attributed to the size of the organization. What I find and what I've heard our asset managers share with advisors time and time again is that the size of the organization really is the ideal size to garner the attention of institutional dealers, but we're small enough that we don't move, we don't really move the market. And what happens with something like that is that it allows us to be selective. And when we're selective in the type of investments that we choose, we have the ability to chase yield more than using economies of scale to help sustain our participating whole life insurance assets. One of the competitive advantages that I think is important to note is our bond portfolio. And why is that important? Well, many of the participating accounts in the industry today are conservative by nature, and they have a very strong weighting on their bond side. And given the way that the interest rates have gone with bonds specifically in the marketplace, I consistently get asked, if the bond portfolio or if the bonds in the industry today are yielding very low interest rates, why is it that we're not increasing our equity component and minimizing the bond portfolio? So one of the advantages that Equitable Life has over some of the other companies, for those of you that have looked at the investments and understand investments of bonds, many of the insurance companies in the industry today use what they call a bond laddering approach. And what that means is that they buy bonds of different durations, whether it's 10-year, 20-year, 30 years, or longer. And they hold them to duration, and then they renew them for the same time period again. That bond laddering approach has actually been, I'm not going to say detrimental, because our company, our competitors have actually generated some yields, but maybe it hasn't paid as much dividends as the individuals felt it was going to. When I was at Canada Life, I remember we had a significant amount of bonds that were held for 20 years or longer. And during my time at Canada Life, the asset managers felt that if we offshored some of those long-term bonds and started buying shorter duration bonds, that when the markets came back up, the dividend scale interest rate was going to see that uptick significantly faster. Unfortunately, the bond yields continue to be relatively low, and you can see that it's impacted the Canada Life dividend scale interest rate as well as the par yield over the last number of years. What do we do differently? Well, we don't ladder our bonds. The size of the organization, as I said, really allows us to be selective. And by not laddering our bonds, what we're able to do is we're able to analyze the market that we want to go into and then match the duration of the bond to how we feel that market is going to perform. Also, when you take a look at the makeup of our bond portfolio, there are some government bonds in there, but we have a slightly higher weighting on corporate bonds than we do with the government bonds. We also invest outside of Canada. When you take a look at our equity holdings, we have some equity holdings in the US, which are backed against US assets. And that really helps to minimize the volatility and hedge against any of the currency exchange risk that can happen. And so that's extremely important, because for those of you that follow the markets, you know that the US equity markets have done relatively better than they have here in Canada. One of the other competitive advantages for our portfolio is the fact that we have approximately 12% of our portfolio invested in Equitable Life policy loans. And for those of you that have talked to me in the past, our policy loan rate is currently set at 6.2, higher than what many of the other companies are offering today. But when you consider that you have a part of the portfolio generating 6.2% interest, that inevitably goes back to policy holders, I think that in itself is a very good competitive advantage to keep in mind. When it comes to yield, as I said, we disclose our yields on an annual basis. You can see in 2020, we had a yield of about 5.1%. We had a very good year last year, and so I can't wait to see what the 2021 numbers are going to be. But this is something that we disclose on an annual basis. And again, although dividend scale interest rates have been decreasing, when you start to see substantially high yields, you have returns to policyholders via policyholder dividends, which I think is extremely important. When you compare our yields over the last, let's say, 15, 20 years, when you stack our yields up against some of the other companies, fully knowing that some of the other companies weren't disclosing their yields, we've had some of the highest yields in 23 out of the last 25 years of every other company in the insurance industry today. And so that's a quick recap on our participating whole life insurance competitive advantages, as well as some of the key reasons as to why you'd want to consider us. Now, we also offer a diversified product lineup. We've talked about our participating whole life insurance, so I'm not going to spend too much time with that. From a term perspective, I have somebody interrupting my call. If you see that, there you go. Thank you, honey. You got to go online, okay? We'll do it. Okay. Thank you. With respect to our product shelf, from a term perspective, here's what I'll say with this. So we are very competitive in our target market. So the family market between the ages of 35 to 50. Are we the lowest premium term company in the industry today? The answer is no, but nor do we want to be. When you take a look at the way that term has gone over the last number of years, term really has become what I consider to be a commodity product. And what that means is that companies are, vying for term market space and really competing against each other on nickels and dimes. If you take a look at a Life Guide survey or a CompuGuide survey, generally Equitable Life isn't one of the top 10 providers when it comes to term. But when you take a look at the dollar difference between company 1, company 5, and company 10, you'll see that sometimes the difference is anywhere from a quarter to $1, maybe $2. So not a significant difference. And one of the things that I continue to tell advisors when it comes to term life insurance products, there's 2 things you want to focus on. One, the renewal premiums. Too often have I heard advisors say, well, if my client is healthy in 10 years, then I'll just rewrite the contract. Fair enough. But too often have I seen 10 years, 20 years come around where the client isn't as healthy as we thought. And all of a sudden now the rates are significantly higher than were expected. Some of those renewal premiums are not as punitive as people think. Not when you're comparing us against some of the other companies. The other point that I want to make when it comes to term is convertibility. The ability to convert term products into a viable permanent life insurance solution is something that you should keep in the back of your mind. At one point, RBC was the most competitive company with respect to term life insurance products, but they don't really have anything worth converting into. Manulife, a little while ago, had some very robust universal life insurance product offerings. And as you know, they made some changes to their universal life insurance product shelf. And so the only available option is the participating whole life insurance, which maybe isn't the right fit for every single one of your clients. We have a very competitive UL product. We have a very competitive participating whole life insurance product, both available for conversion options on our 10-year and 20-year terms. We also have, as I mentioned in the past, this very unique term 30 to 8 or term 65. Depending on the age of the client that you are talking to, these clients would either pay premiums for 30 years or they pay premiums to age 65. Why is it unique and competitive? Many of the other term 30 products that I've seen in the industry will keep the premiums level for 30 years. And if a client wants to continue to keep the contract in place, some renew on an annual basis, which maybe isn't the most effective or efficient for a client if they're looking to stick to a budget. With ours, if the client is younger, you're locking in a premium for the next 65 years. All products are convertible. So our term 10 and term 20, both are convertible up to and including age 71. Our term 30, because of the way that the product is designed, that is convertible until age 60. From a critical illness perspective, we have a product currently, again, very competitive in the family market space. Our permanent product, or all of our products actually, it's 25 covered conditions for adults. We have an additional 5 childhood illnesses. The advantage of our product over some of our competitors is that the product is the same for children or adults. I know that there's a big appeal to the Sun Life Juvenile Whole Life or Juvenile CI product. In the past, we had a Canada Life, a Juvenile CI product. At Equitable Life, it's the same product, whether it's a child or an adult. You can insure a child as early as 30 days old, up to and including the maximum issue age. Currently, we offer a term 10, a term 75, and a term to age 100 with varying return of premium options. So we have a return of premium on death, return of premium on surrender, or return of premium on expiry. Our return of premium on surrender on our term to age 75 and term to age 100 contracts offers a 75% return of premium in year 15. And then it increases to 100% by the time they get to year 20. So it's a very simplified ROP product. I know there are other companies out there that are offering many permutations when it comes to ROP. Ours is very simple and easy to understand for a client as well. I talked about our universal life, very competitive when it comes to conversions. Why are we so competitive? Well, there's an advantage and a disadvantage of focusing on your spearhead product. The disadvantage is that the majority of the sales that we see at Equitable Life today happen to be participating whole life insurance. The advantage, though, is that because we focus so heavily on our core product, our universal life insurance premiums have not been adjusted. And what we've seen over the last number of years with some of our competitors, their universal life insurance rates have increased substantially over the last 5 to 10 years. Our pricing on UL hasn't changed. And so at one point, I used to tell advisors, we're high priced, don't come to us. Last year, I ran multiple scenarios with our UL product where we were actually more competitive because all of the other companies raised their premiums. And so I think it's worth looking at us if you want to get into a universal life insurance solution as well. With respect to our online application, so Easy Complete is our online application. You know that in order to access Easy Complete, it requires you to have an active advisor selling code. It is accessible through Equinet, which is the advisor website. And the application was designed for both in-person and non-face-to-face sales. It is designed with built-in electronic signature capability, and it really helps move business from submission to commission significantly faster. Here's a quick snapshot of what it looks like from a dashboard perspective when you sign on. When you sign on, you can see that you have the ability to start a new application, both for insurance and savings and retirement. And the good thing about this is that as you go through the application, everything saves. And so if you don't finish an application today, when you re-enter the software, it'll take you back to the same spot that you were at previously. When the application is submitted, what happens? And here's one of the things that I wanted to bring up. And so an email is sent to the MGA indicating that an application has been submitted. Once the application hits the system, a policy number is generated. And then at that point in time, what happens is the same thing that would happen from an underwriting perspective. The communication is between the MGA and Equitable Life. One small caveat: if you are using the online application or have used the online application, in the advisor's report, you are asked to input an MGA email address. Oftentimes, when an advisor doesn't know the MGA email address, they put their own email address into this part of the application. What that does is it tells the system that you are the one to be getting all of these updates, and sometimes it keeps the MGA out of the loop. And so one of the things that I encourage you to do is to talk to Taro or talk to Amy, figure out what that MGA email address is for new business at AT. And if you're doing the online application, make sure you put it in the advisor report so that Amy's office gets all of the updates when the application is submitted. What happens left when the application goes into head office? So here, very simply, 3 days after the application is submitted, you can see it on Equinet. That's actually gotten a little bit faster now because data entry is moving a lot faster than it was in the past. We also have the ability to use Easy Upload, which is built into Equinet. And Easy Upload allows you to submit documents electronically to our back office system by simply using Equinet to send a copy directly to us. And I can show you where that is. When is an application non-face-to-face? Well, in this environment, I don't think I need to explain that to you, but non-face-to-face or virtually means we're doing this, we're on the phone, we're doing Skype, whatever the case might be. And so this application system allows you to get those forms signed electronically. I'm not going to spend too much time with what applications can you sell. Pretty much the competitive advantage here to us is you can sell Every single product that we currently offer, including investments, there is no maximum restriction when it comes to the product offering. So right now, you can sell whole life for up to $20 million, and you can complete that using our online application system. I know with some of the other competitors out there, there is a restriction on the face amount that you can use when you're applying using the electronic system. I'm not going to talk about signatures here too much. So there are some resources available. We have a practice site. Oftentimes when I have a client or an advisor reach out to me and say, Rudy, I need access to the online application. Can you do a training session with me? Very candidly and politely, I say that if that is the position that you are in, I urge you to use the practice website, because oftentimes what happens if we set up a call to go over the online application, I end up going through the practice website. And I think that there is no better practice for you as an advisor than to actually try to do it yourself. When you go on the practice website, you can put in whatever information you want. You're not going to break the system. The information is going to be automatically deleted after a number of days. So there's really no concern with any privacy, but it gives you a good look and feel for the flow of the application. And so the last thing I want to finish off with is some newsworthy things that I think are important to share. Last year, we surpassed $1 billion when it comes to our participating whole life insurance account. I think that that's important. Why is it important? Is because we continue to see our participating whole life insurance sales growing. And that's what you want out of a participating account. More assets means more potential for better returns and better yield. And so that's extremely important to share with your clients, along with the strength of the organization. Although long overdue, and I say this chuckling, we finally accept e-signatures from DocuSign, Adobe Sign, any of the other signature platforms that you are using. The one request is that you have to add e-sign at equitable.ca as a non-signing reviewer. And what that allows us to do is that it allows us to get a copy of the signature requirements automatically. Now, depending on the platform that you're using, this is done differently. I've seen how it's done on DocuSign, where you select, a non-signing reviewer, you input the email address that you want it to go to. And I think that that's extremely important. It took some time, but I'm happy to say that we accepted on new business and in-force applications or in-force changes as well, as long as you add e-sign at equitable.ca as a non-signing reviewer. Because we moved to a digital environment, we have seen an increase in auto approval. So not just with Equitable Life, but with any of the companies that introduce their electronic applications. Part of the value proposition of introducing an electronic application is that some of these cases were meant to be approved automatically by the system and not be looked at by an underwriter. So I'm pleased to say that, at the outset of our online application system, we had an auto approval rate of approximately 8%. At the end of last year, this auto approval increased to an impressive 25%. And the goal this year is to get this up to 30%, meaning that when you submit an application online, there's no underwriter intervention, but the system is simply underwriting the file, looking for potential, medical issues that should warrant an underwriter. And if that's not seen, then the file gets approved automatically. What we are going to see this year, because of the continued in the environment that we are in, is increased non-medical limits. Many of our peer companies in the industry today have increased their non-medical limits as high as, 5 million. I don't know if we're going to be as high as 5 million. I'm pleased to see that we are going to be moving in the direction to increase our non-medical limits. At the same time, I will tell you this, as much as I like it from a competitive advantage, I'm not a fan. It changes a few things. When you take a look at term life insurance, when you increase your non-medical limits, that means you're also increasing, or I should say decreasing, the ability of a client to get preferred rates if they're healthier than your average client. So right now, our non-medical limits are set at $1 million for anybody that is buying term. Unless you're applying for more than $1 million, there is no preferred underwriting criteria, which is unfortunate to somebody that might be healthier than your average client. At the same time, I do feel that sometimes the increased non-medical limits are marketing, and there's a lot of smoke and mirrors. You know, I have a lot of advisors that I work with from other MGAs who do some substantial business with Sun Life, and I don't like knocking other companies down in presentations, but I do like to share information that I get from other advisors. And, you know, one of my very good friends last year who does a lot of business with Sun Life said, Rudy, you know, I sent a lot of business to Sun Life and their non-medical limits are fantastic, but I'm also getting a lot of clients being asked for APSs. And the insurance company going out to obtain APSs. And I can see why that would happen. You know, with an increased non-medical limit, as healthy as you think a client is, anything that might resemble a medical issue might warrant some clarification from the client's doctor. But on the good side is we're going to be more or less on par with some of the companies in the industry today. We're going to be introducing some very competitive CI product changes. Those are coming as early as February 17th, from what I remember correctly. So we're going to be introducing a soft launch on February the 12th. You're going to get a video that's going to be released to the industry that speaks to some of these critical illness product changes. We're going to see more competitive pricing. We're going to see enhanced definitions. We are going to see better return of premium options. We're going to see with a par product, is the chargeback prorated or not? So the answer is not at this time. And so for the first 2 years, if I remember correctly, you're still going to be penalized at 100%. But again, it's an improvement to what we had before, where it was a 5-year chargeback, and you know, you were on the hook essentially for a 5-year period. Going back to CI, so enhanced definitions, potentially more cost of insurance options. We're going to see better pricing, better return of premium pricing. And we are going to be pairing up. So as you would have heard, Best Doctors changed their name. So, you know, for those of you that work with other companies, I recently got an email from BMO saying that Best Doctors has changed their name. Many companies have gotten away from Best Doctors because of the exorbitant costs of having that built into the contracts and not a lot of usage. So when we were looking at our CI product redesign, one of the things we looked at was a service that was comparable to Best Doctors, but made it more client-centric. And when we release our CI product, I think you're going to be pleased with the offering because it really focuses more on the client as opposed to focusing on a potential second diagnosis that maybe a client won't use, or second opinion that a client might use, maybe won't use. Who really knows? But it's going to be extremely, extremely competitive with what I've seen so far. And the last thing I will talk about is whole life enhancements. So obviously, being our spearhead product, there's a lot of discussion around how we can make our whole life significantly more competitive. And so one of the changes that we made last year that I failed to mention at the beginning, we're able to add a term life insurance rider to the participating whole life insurance contract for the purposes of increasing the maximum accelerator deposit option room. That allowed us to be more competitive to Manulife, which was one of the companies that was offering, this option where a client could buy $100,000 of whole life, spend $1 million on term, buy $1 million of term 20, and then their accelerator deposit option room would increase substantially. We made a more conservative offering in the marketplace, and it actually became very, very appealing to a lot of the clients that we were working with. The Manulife numbers in some situations illustrated better, not all the time, better. But then that to me leads to question how a company like that can be showing better numbers than many of the other companies when we're all investing in the same economic environment. So that was one of the changes that we made. The other change that you're going to see is over the last year, we've been talking about a 10-pay. For those of you that are or operate in the high net worth market space, I know that there is an appeal for a 10-pay product. And so that was one of the things that our pricing team was working on behind the scenes. From what I understand, that will be released in the first quarter. I don't know when. I suspect it's going to be sometime in March because we are going to focus on the CI first. But these are all very good product changes and very good newsworthy points to discuss, given that the whole intention is to try and get Equitable Life out there more and really to get you as the advisor to considering partnering with Equitable Life for your clients as well. And so those are some of the changes that are going to be taking place. That's really all I had to share with you today. I can open it up to any questions if anybody has any questions. And yeah, throughout the rest of the year, we'll be doing some more presentations as things come up. I know we'll focus on a CI product launch, but for the time being, I want to thank you for your time. I want to thank you for your support throughout 2021. And I really do hope that we can continue to be business partners for the remainder of the year. So thanks again.
Hi. Thank you. Do you have any question, or you can put into chat? And I think we have one question from Nanette, Woody. With the PAR product, is the chargeback prorated or not? No, you mute yourself, Woody. You mute yourself.
I also see myself freezing, so I don't know if everybody else sees that right now. And so the way that the chargeback schedule works at this point in time, I don't believe it's prorated. From what I understand, it's 100% for the first 2 years, but I can clarify that with our team to see if it is prorated when a client cancels. But yeah, my understanding is 100%. But I will clarify that and see if there is any changes to that.
Mm-hmm. Thank you. And I think Woody gave us a good idea about what we are looking forward to, and the e-app, as well as why we could, when we have a competition, people say that this is small company. I think the few slide, maybe Woody, can I have that slides so I can send it to whoever wants the slide, let us know. So the first few slides is very powerful. So when it's for the competition, right? When people say that it is too small, then we can do something about it, right? Yeah.
Yeah, I can share this presentation with you, Amy. So I'll send it off as soon as we sign off, and then
you can give it to Terrell. Yeah. Mm-hmm.
Okay. Fair enough.
Thank you.
Perfect.
Thank you. So thank you for coming. We are going to have the team meeting right after that, and we have the CE credit today. Okay, so I hope everybody can stay on. It won't be too long for the team meeting. I have some idea for everybody. Okay.
Perfect. Yeah. Well, thank you, Amy. I appreciate your time. Have a nice day, and have a good team meeting. Take care.
Yeah. Thank you. Okay. Hi. Now I have. Can everybody hear me?
Yes, Amy.
Yes, Amy. Oh, good. Okay, yeah. Okay, now I have an idea about, today I have a few things I want to talk about. First of all, I want you to have your internalized sales process. So what do I mean by internalized? You hear a lot of people coming and talk about their way of selling. Oh, you have to do this, you have to do that. And they don't know about your client, right? Everybody have their own type of clients. Some people like to talk to the family. Some people not like to talk. Most of their clients are nanny. Some people, most of the client businessmen. So they have their process, and whatever you hear from other people, you can internalize something for yourself, right? So I want to show you a very important idea is to make people feel that they have to have a planning, and they have to agree with you. So there are different ways. Recently, I hear agent who are talking about financial cake, so they use the financial cake. So you bake it, the basic, and then the top, and you have to have a good base, otherwise they will collapse the cake, right? But most of the people like to use the financial pyramid. I also like to use financial pyramid. The reason of that is if you go upside down, then this triangle will trouble, So when we come to there, we have to.
Sorry, Amy, you are not sharing anything.
No, I'm sharing here.
Oh,
right?
okay.
You see it? I'm sharing it right now. Okay. So I want to write it. Okay. So this is financial pyramid. And if you would like to bake cake, you can use financial cake. If you can think about a way that related to you better. Okay. So let's say when you go to see a client, the most important thing, no matter what you prepare, I think, do you agree that the most important thing is to look at the cash flow? If they have no money, no matter how much they like the plan, right? I think you would know that they have a few layers. Okay, so you have to know exactly the first one. You have to know what is it? Cash flow. Please go to look at the cash flow with them. Cash flow. Okay, so how do you do the cash flow? We have you have to do your own form. Okay, or I can give some to you. So you ask them about how much is the income, not the gross income. How much is the take-home income? How much is the family take-home income? And also the income, also they have something like the children. They have the kids money from the government, right? So they have suddenly subsidized from the government. So ask them about the positive, the cash in and the cash out. In that case, you can see each month how much they have. Do they have anything coming out when every month? You have to help them to look at the cash flow. And then if you find out the cash flow is negative, then you have to think about a way to help them to manage the cash flow, to reduce the expenses. How? Before, when I dealing with a lot of people like working class, like office people, working class, even professional, I always tell them to go to pack lunch. Packing lunch can help them to save at least $300 to $400 per month. Okay, this is one of my way, right? Or you can see where they like to do a lot of impulsive buying. Then you tell them that to restrict them the buying habit. Maybe instead of $500, anything up to $200, they have to think and go on and put it aside for another week before they push the buy. Okay, so something like if you go online, right? But if they go out to shopping mall, they have to think about whether they have to buy this one. So you have to manage them, the cash flow, to analyze for them and help them to create some cash. So if you cannot create cash, he's talking about the spending. Okay, how do we take care of their spending? Okay, sometimes we cannot take care of their spending, then we cannot increase the cash flow. Or you ask them, can they do some extra work? So some people can have some part-time work, right? So that is, they can, if they have a part-time work, they can increase the cash flow, okay, and reduce the spending. So the cash flow will be a lot better. So that is very important when you see any client to do the cash flow first, right? Then you want to know how much is the debt. Okay, how much is the debt, right? So what do I mean by that? So when you do the cash flow, you know that they have to look at whether they have enough money to pay the mortgage, everything. They have to put aside the money to pay off the debt. And then you have to manage the debt. So the manage of debt is you have to see whether they have a good debt or bad debt. Okay. Do you know that a lot of people, they have a very bad habit of accumulating money in the credit card? So they instead of doing that, might ask them to redo their mortgage and get a higher amount and pay off all the high interest debt. So paying off the debt, helping them to do, we call debt management. Okay, so if we can do that, we can also increase the way of getting the money for us, right? A lot of people say, oh, Amy, I don't have enough money. I don't have enough money to spend. I don't have enough money to live. What do you think about getting protection or insurance? Forget it, So I would say, let's look into it. We look at the cash flow. We look at your debt. We can do a debt management for you, right? Then another one is we want to see if they have some emergency cash. Okay, that means they have to see if they have some emergency. Okay, we call it unpredictable or predictable expenses. Okay, so they have to get some emergency cash. Okay, and what is predictable? That means, for example, I need to fix my car. It's predictable, and then unpredictable is some people some of the family member ask some money from you, or they have some people in your country, they need some money. So it's called unpredictable cash, right? So we have to take that into account. And then on the other hand, in order to do that, we have to protect our family. Okay, on all this debt and cash flow, we have to protect for the unpredictable things happening, right? Critical illness, death, disability. So we have to look at that. For disability, if they are employed by a company, so they should have already taken care of the disability insurance. If they are a top management, you can ask them how much disability do they have, right? Let's say they only have 3,000 max disability. You can do the top up, okay? And then for critical illness, you can see if you can buy a small critical illness like to cover the mortgage. It's a 10-year term. It's not expensive. 20-year term, if the budget is a concern. So you can also take care of the critical illness. And the life insurance, let's say you have a mortgage for 20 years. So ask them to think about getting a life insurance at least for 20 years to take care of the mortgage. So we can do the calculation of what we need for the debt management, like the debt, for example, like how much is the mortgage? This is the basic. For the term insurance, this is taking care of all these expenses because we have not come to investment yet. So the people will say, oh, Amy, I also want to do something called putting money in the investment assets, which is good. I say, yes, do this. You have to assign money to do all this investment, right? But how are we going to take, what type of investment should we do? How are we going to diversify the investment? That is what we can come in, okay? So diversify the investment. So you can talk to the client about how to allocate the money. One of the things is to do the whole life policy. Why? Because when you have a good, if you are doing well with your investment here, we are going to have something called estate planning. The upper here is the estate planning, estate, right? So what is estate planning? So they will say, if you are investing a lot of money in your real estate or mutual fund or segregated fund, and they, after 20 years, 30 years, they increase a lot. So you will have an estate value to pay. And I can do the calculation with you. You know, remember that Canada Life has a good calculation to look at how much capital gain they have to pay. So for the people who have a little bit more money, they can do investment other than protecting themselves with the down there. We can look at the investment, helping them to do the allocation of the investment. And then we can talk about the estate planning. So this is something that I want to share today. It is my idea, you know, that you can use your own idea to think about the pyramid or cake or something that you want to build, you know, you want to create on your own. A lot of people say we are financial architect, you know, whatever you want to, you have to internalize yourself, right? To brand yourself, and then, for example, I'm so happy that I get a very good branding for my insurance, right? It's called Insurance Goddess. It's give me some, that means to give me something that they know have the commitment, you know, and I have my job is to take care of people on the insurance. For the insurance, it's not only insurance, we can do estate planning, right? So that is a branding. Or you can put yourself another branding. I'm a protector of new immigrant, something like that, right? So you think about a way, and then if you have most of your clients are new immigrant, you can use your own pyramid, to explain to people how are you going to take care of the pyramid, and also when you have investment, how are we going to take care of that because of the tax in Canada. A lot of new immigrants not understanding the tax in Canada, so we can explain that, right? So today, this is a very simple idea, and I want people to have their, not necessarily use the way I am talking about. You can create your own, So like, I hope everybody, that is an assignment for the people who attend today. I wish everybody can have their own pyramid, and I will call you and see whether you have your own design, and then you can share with me, and in that case, you can internalize. Because when you look at other people, how they do it, you never internalize yourselves. This is always Amy way, or this is Nanette way, This is not something, this is my way of taking care of my clients, I want you to know more, to do all the research and to internalize something for yourself. Okay, so that is something today I want to talk about, right, for insurance. Another one is very important. I'm reading some books right now, and a lot of books, and I'm going to share some of the idea. I think it's very important that there is a frequency for what we are thinking. We will have to increase our frequency. In that case, we can attract a lot of positive thinking, positive people to come. So we have to tell ourselves, I'm a rich person. I'm a rich when I'm born. I'm rich internally and externally. Rich in the sense is not only money. I'm rich. I am healthy. I have like a good friends. So that is something a rich person too, right? So whenever every day we have to appreciate that you are a rich person, a very positive person, and I'm helping people. When you try to help people, not only thinking about the money you're earning, try to have your heart to help people. Sometimes even though you don't earn a lot of money, but you feel good because you are helping someone to design their pyramid and help them to take care of that, right? So the most important thing is to attract positive energy, positive people. Every day you have to tell yourself, I am a very good person to take care of my client. I want to attract the client who need my help, and I believe what I can do for them, and I want my client to believe in me. So that's why I have to learn. I learned from Rudy, Equitable. Now I also look at how Amy is selling using her own pyramid, and I think everybody can create their own pyramid and have a very positive attitude when you go to see the client. It is very natural when you go to see someone. People can see whether you have a high frequency or a low frequency, whether you have energy or you don't have energy, whether you have confidence or no confidence in yourself or with them, right? So this is how you could make them to see if they want to believe in us. When we talk to people, they might not tell you the true story. They say something that's superficial. It's not their real, like how they see it inside. So we have to, it doesn't matter how they see it, but we have to be very strong on our ends. In that case, our frequency can radiate to them and to make them believe with us. So this is what I'm learning right now, is the frequency. We have, let's say you have someone who are low frequency, you are high frequency. What you need to know is you have strong enough to pull them up to here together with you. This is what we want to do. So believe what you can do and try to be a very good agent and take care of their cash flow, help them to create some cash flow for them, help them to reduce the spending, increase the income if possible, and arrange all the debt for them if they need to, get some emergency cash and protect all these basic. At the same time, help them to do investment and take care of the estate value when they are retired. Okay, so in that case, we take care of everything for our clients, right? Okay, this is all today. And do you have anyone who want to share some of the idea? But as I mentioned, today I will call you, and maybe you can call me and give me your own financial cake or financial pyramid or financial design. When you see the client, your own, not mine. Okay. So that's it. Any comment from anyone? How do you think about that, Nima?
I have been trapped many times, Amy, and misled by the client when I was skipping one of these layers.
Yes.
Sometimes the client gives me an impression that the cash flow is very healthy, or the other way around, doesn't matter. And I would
You
trust
have
them
to find
without
out.
drilling
No, you
into
have
it,
to
without
find out.
digging into it, and then the
Yeah.
whole pyramid fall apart.
Yeah. So you like the idea, what I'm trying to explain that, right? To get to the basic, right?
Yep.
And also never, as I mentioned, Nima, when we are dealing with our client, we have to understand we are professional. So if the client tell you something, you have to make them to believe what you are talking about. You know, we are talking about this not because we want to do business. We want to help them. So this is something that you have to, instead of buying into what they say to you, oh, I don't have the money. Oh, this is a tough year. Very negative. And then you go with them with the negative. You have to get them to understand that, oh, I'm really with you. I understand your situation, but let's go to, we have always have like God, the universe is nice to us. There is always positive energy. We can always come from our downside, you know, and then we can pull to look into our financial pyramid and have more planning. You know, so no worry about it. Tomorrow is always better.
Yep, absolutely.
Okay, yeah, Nanette, are you here, Nanette? So any other people who want to give some comment now?
Yes,
if not,
Amy.
yes. What do
Hold
you
on,
think
I'll just
about?
lower my other spool. Just give
I
me
know.
1 sec. I'll just
Thanks for
lower.
coming, right? So like, can you explain that you must have your own, right? Financial planning, financial pyramid to understand your client, right?
Yes. I really
Yes.
like your idea, Amy. I think it's really a nice strategy. And when people knows that you really do care, I think they will find a way how to integrate your planning or your protection. Because the most important thing, if they understand why they're paying that much, they will make a way. Because like, if you love a nice car, even though it's hard to pay, if you really want that one, you will do your best. Like that one too, because if you understand the importance of that one, you will find a way. You could adjust your other payables in order for you to allot something for your protection. I like your idea. It's so simple, and I think it's easy for them to understand. And at the same time, you could help them manage their cash flow, that every month they have something set aside for their protection, for the family, and paying their debts. I love that one.
Thank
It's a
you.
brilliant idea.
Yeah, thank you. Yeah,
Especially for the new ones.
Yeah. I hope everybody appreciate the team meeting. Is like, I will try my best to think about different way. You know, if you have some idea, welcome to call me and share with other people as well. I believe in sharing, and then as Nanette mentioned, integrate what you learn. You know, it's the most important thing, right? Integrate. And also, for example, investment. I hate to tell people not to do the, please don't do the deferred charges. You only, the people who do deferred charges only invite problem. And right now, insurance company, when they have any complaint, they will charge back 100% from the client. I mean, from the agent to the client. This is 100%. So why don't we do something like the other one where they can charge back the agent, right? So thank you very much. Oh, thank you, Evangeline. You are giving us a lot of encouragement. Okay, so is there any other thing? I think this pyramid can apply to anyone, not even for the professional. You know, it's
Yes.
not only for the new immigrant. You know, so something that we have to after we do that, we have to look at the cash flow, you know, and how to take care of the cash flow from there. All right. So maybe next time we can have a study about how to look at the cash flow. How can we take out more from the client, more information from the client, right? So maybe we can have a case study, not case study. Instead of doing a role play, I think, right? Maybe Nanette and I can do a role play, or Nima or anyone who willing to do the volunteer. We can do the role play, right? Okay, so that's all for today. Happy New Year, and also happy selling. Okay.
Thank you, Amy. Is there a schedule for IE investment, just to give us a new perspective for this year? Is there any schedule?
Yeah, I mean the schedule for all the webinar, right?
Webinar for IE investment?
Okay, I will make sure that we have that as soon as possible. Okay.
Yeah, thank you.
And also different investment, like Canada Life will have one, IA and other company as well, right? So we will look at that. And the other thing is we get the CPP MGA, and that one, if you have anyone who cannot buy the insurance, CPP is an excellent way. CPP IA Excellence is the best company to give people who cannot buy insurance. Like they have some problem from diabetes and for other issue. Okay, so stay tuned and talk to us. We're going to have more training on that. Okay.
Okay. Thank you.
Thank you. Thank you.
Thank you, Amy.
Thank you, Amy.
Thank you. We talk again. Okay. Bye.
Bye.
Bye. Bye. Bye. Bye.